if you compare it to the rest of the global markets, we're in a fairly decent spot.
Well, let's begin this show with a global voice. Peter McGuire, the Chief Executive Officer of XM.com, joins us right now on the show in our studios to talk about all that's happening around the world. Peter, good having you. Thanks so much for taking the time out and being in our studios. China, let's start off with that. Sharp gash today, and there were some sell calls on select heavyweight names, maybe, which is what the Bloomberg story is suggesting was one key reason, and the nervousness around maybe a market which has risen too much too soon in too short a period of time. What do you make of this and the growth pangs that the world seems to be seeing?
Well, first off, I think it was parabolic. Some of those rises were just extraordinary. When you see a graph and you notice that those market moves aren't normal. We've seen huge volatility over, say, the last 4 or 5 years for that Chinese market. It was massively sold off and now it just ramped up. So like any market, if you're up, when some of those stocks are up 60, 80, 100%, 200% in very short periods of time, so you're going to see, markets become exhausted. And that notice coming out, I think, realise that any market that's risen for the last 8 or 9 weeks is having a bit of a holiday. So I think it's not unusual to see sell-offs like that in, day trade.
But the point being, would you reckon that this was a one-off? Or do you believe that the next few months could see a volatile China, a volatile European region because of the growth pangs with a downward bias?
Possibly a downward bias, but I'd say yes, we're going to see. There are too many moving parts that aren't being put to bed. First off, the US versus China trade deal. That's still a work in progress. We're not sure. I mean, 3 weeks ago, everyone thought that it was going to be a done deal and things were going to be good. Now it seems to be they're both at edges of table and no one's prepared to put a deal together. So there's the first part. So that creates uncertainty, which is volatility. Secondly, what's happening with Brexit. Thirdly, North Korea and President Trump. So those moving parts, I think, are going to edge through. Now, we understand the growth scenario coming out of Europe is very, very contained, and it's going to be a pretty... 18 was a terrible year, 19 is going to be worse as far as euro growth. So I think that's really, you see that euro trade, there's probably further downside there, 107, 108, currently at 112 or 111, so I think there's further push to the downside. US dollar stronger, and I think that's where we're going to be over the next 3 to 4 months.
You think that foreign money, which has somewhat been contained to move into China in a big way because of the trade war concerns,
sure,
could find its way back into China now that talks of a deal being struck by the two sides is more imminent?
Well, it's imminent, but we're still, poles apart. Nothing's been actually put to paper, and I think that creates that little bit of, naturally, uncertainty. And like anything, yes, funds are flowing in there. We're thinking as far as infrastructure, with there's a big push to try and get growth into that Chinese market, and it's been demonstrated as far as the massive sell-off you saw in September, October, November last year. It's had a huge rebound. So at the present, it's onward and upward, but I feel as though that it'll probably be contained over the next matter of a week or two as far as a breather. Markets become exhausted when they either move too quickly to the upside or the downside, and that's what I think has been evident over the last 8 to 10 weeks. It's been incredible trade. Everyone's been long, and now's the time probably to just take your breath and profit take.
Mid-2018, there was a clear divergence between what the Indian equity markets were doing versus some of the other emerging market equities. That has seemed to take a complete reversal now as we have started 2019. Where does India fit into the entire equation?
Well, I think it's been incredible growth stories over the last, say, 5 to 7 years. It's been extraordinary. And when you're mapping out that Sensex and Nifty, they've been, great markets to be a part of. I feel as though that momentum will continue very much. You've got an election here in about 6 to 8 weeks, but I feel as though the momentum will edge higher in 2019. It's a sweet spot. The growth stories and the growth horizon over years ahead are nothing like anywhere else in the world. You're looking at the euro market being decimated. Whereas the Indian market, strong growth forecast, everything's green light all the way through. So whilst you'll see valleys and peaks in trading, I still believe that there's plenty of upside yet for both markets.
What do you think is the biggest risk to emerging markets now that, at least from a US standpoint, we've got some more clarity in terms of the future action from the Fed? They're talking about rolling off the balance sheet tapering by the end of 2019. So cues out there seem to be slightly more positive. So what could be the threat to emerging markets?
Well, possibly higher energy costs. That's not a good thing. But I feel as though they're fairly contained. But again, it's geopolitical, weather outages and so on, which is the unknown that can greatly affect price. What happens as far as the Fed? Do we see something happen left of field that's not traditional, and then that can really upset markets from a volatility standpoint? But I feel as though that the emerging markets, they're going through their sweet spot again. The things are right, and right for a number of reasons. First off, population base. Secondly, huge demand, and of course, they're just growth centres. Everywhere's under infrastructure booms. There's building and construction going across most of the emerging markets. Everywhere you travel, you see cranes, you see construction. You go to Mumbai, and I'm here now, and you see underground railway. This is a common occurrence across most of these emerging markets. So I think that the storyline's very, very contained. It's a great time to be. I was with Mark Mobius a couple of weeks ago, and he's talking the emerging markets. 2020s are going to be great times. Absolutely, he's big on India. He's big on the emerging markets, but primarily I think India is the sweet spot. And those storylines aren't going away, and I feel as though the next decade are going to be absolutely outstanding returns.
What about the currency play? And do you think that stands to be a slightly weaker point for emerging markets?
Well, that US dollar index is a realisation. In the last year it's gone from 88, 89 to 97.5. It's been a two-way, the last 2 weeks has been outstanding, boom to the upside for US dollar index, and there's probably more momentum there. There's every chance you might see a 99 handle, if not 100, in the short term. Let's see what happens as far as rate rises. What's going on? We've got those numbers coming out tonight as far as non-farm payroll. They're not going to be as good, I think, as far as that last month's call, 304. But this one, where I think analysts are calling that 180 to 190 sort of headline number, and they're fantastic numbers. So US dollar, what happens as far as US economy? It seems to be green lights there in a lot of ways. That's still, I think there's further upside there for that US market over the 2019 period.
One question on what happens to yields. Europe, ECBs or the stimulus that came out of the European region yesterday brought those yields lower.
Yeah.
One would reckon that Fed commentary, as they are suggesting as well, and as I think you've spoken about or referred to in your mails a couple of times in the past, would suggest that there is not a heightened risk of yields or rates really shooting on the upside over the course of the next 9 months.
No, there's not.
How much risk of these yields shooting on the downside for not just the US, but across the world?
Well, that comes down to the governments, that comes down to growth forecasts, where we're going as far as IMF numbers.
Which is not looking good.
No, it's not looking good.
OECD is not...
IMF numbers, all of these sort of things. So, there's every chance that some of these economies will have to actually cut rates. So, this new normal and these growth sort of targets, yield curves, flattening of them, who would have thought this time last year we're saying 3 to 4 rate rises in 2019 for the States. Now you might be lucky to get one. Now what's happened, and you may not get one. The next move might be to the downside. No one knows. So as the year rolls on, and then we take on board as far as what's going on with Europe, all of these factors need to be embedded into the global scenario. There aren't many Indias in the world. As far as the growth horizon and what's on the out here somewhere as far as big headline numbers over the next 3 to 5 years, 10 years, 15 years. A lot of these markets are very mature if you're looking at the Eurozone, and they're going through very tough times. Politically, they're going through tough times. They're also going through growth sort of hemorrhaging. And this is going to be fascinating how that interplays into the global situation and where the US plays. Does Trump get back in? Modi get back in? What's going on over the next, 18 to 24 months as far as political is going to be fascinating.
Okay, I have one last question, Peter.
Sure.
And that's on the charts. I know you look at charts very, very closely too. You and your team combined look at a lot of charts very, very closely.
Yep.
What on the commodity side is looking very, very strong or very weak? We are predominantly obsessed with crude. Have you looked at those charts or those fundamentals recently to figure out what could happen to crude over the course of the next, say, 3 or 6 odd months?
And just to add to that, the talk, obviously on the fundamental side, remains that a supply crunch could make iron ore prices shoot up to almost $100.
Sure.
Is that something that a setup on the charts could indicate?
Well, a couple of weeks ago, I thought that iron ore would get there through that $100, and then but it had a very, very strong move from that start of January. It was really very, very strong, and then it petered out. So I won't be surprised to sometime in April, early May, that we're at that triple-digit number. As far as crude's concerned, who would have thought a year ago or 2 years ago you would have had 12.1 million barrels a day as far as production? The largest in the world is the US. So that's a little bit of a wake-up call. I'm off to
Azerbaijan.
Azerbaijan, I should say that. Baku, Azerbaijan, Monday week, and the JMMC meeting. So that's going to be interesting how that plays as far as Saudis, what goes on with OPEC and so on. So all of those moving parts, they want a higher value. They want $65 to $75. I'm not sure whether it's going to achieve it. That's the unknown at the moment. But it's had a very, very strong move to the upside since Christmas. And if you're a producer, I think that you'd have to be very satisfied at the present time, but there's possibly more momentum to the upside across that market. I'm sitting on the sidelines with gold. I thought it'd be a 1360 by now, and now it's flat out getting through 1300. So keep an eye on that one as well.
Yeah. Okay. Peter, lovely having you. Thank you so much for taking the time out and being with us, and safe travels.
Thank you very much. Cheers.
Cheers. Well,